Good morning, everybody, and welcome. It is Thursday, the 24th of April, 2025. Gianni DePoci here, live with you for Benzinga. We are really excited today because we have a live event celebrating an anniversary with the Chicago Board of Options Exchange, where we are discussing the anniversary of the zero date till expiration, the zero-DTE options anniversary. And I'm joined here today by the Vice President of Global Markets, Henry Schwartz, from the Chicago Board of Options Exchange. So let's go ahead and bring Henry on. Henry, how you doing today?
I'm doing great, Gianni. Great to be here. Lots to talk about, that's for sure.
Indeed. It's a very exciting market you guys have built out, and thank you for joining us today. I'm really excited to discuss what the developments are that you have to update us on, especially given the latest volatility we've had. So I want to know how these products have done in the volatility. Obviously, there's been some big winners, and I'm sure some big losers as well in this tape. So we have a lot to discuss, and let's go ahead and get into it.
Awesome. I mean, it's actually also the 52nd anniversary of listed options
really?
as a product. Yeah, that was April of 1973.
So did you launch those like at the same time on purpose?
No, I don't think they did, but it's serendipitous, I guess.
Oh, well, nonetheless, pretty cool.
Okay, so no, I will feel free to interrupt me.
Yeah.
But what I've prepared is some data on just kind of how this market has evolved, and really where we are. So if we go ahead and get started, the first slide just simply shows the average daily option volume, and really when these options expirations were added. Okay, so we spend a lot of time educating, which we're more than happy to do, but occasionally we also have to kind of correct some people, on who may say, oh, somebody invented zero-day options all of a sudden, and now it's this incredibly active product, and there's some controversy over it too. And this slide is really just to show, for the last 15 years, what the option volume has been, broken out across index options, ETF options, and single stock options, and really where these new expirations were slotted in. So, and it really has been a gradual process. So 3 years ago, this week, we did finally fill in the Tuesdays and the Thursdays in SPX, which did make 5 days a week in terms of the expirations. But before that, if you go back, Mondays and Wednesdays were added back in 2017. Fridays were actually added back in 2005. And so what you have now is 5 days a week in index products and in some of the most extremely liquid ETF products. And we also see, just to highlight, the volume, is we're at record levels. In lots and lots of records have been set this year, but you can kind of see where we are right now. We're pushing about 60 million contracts a day across the entire market, and we're going to look at kind of how much of that really is in the zero-DTE, and really why that product has kind of taken off. So if we go to the next slide, again, I just want to point out, I'm not going to go through all of these, but zero-DTE options are not really a thing, right? They're the same as monthly options and quarterly options. It's just that they are listed every single, for an expiration every single day, out about a month. Okay, so so right now you can trade an SPX option that expires any trading day of the next, going out about 35 days. They're available at SPX and XSP, which is the mini SPX, and SPY, Russell, and the NASDAQ complex as well. And then they've actually kind of filled in some shorter term options in some of the ETFs like gold and silver. But there's a little bit, it's not quite daily in those. And then I do want to point out that, in terms of the fiction, these are just options. You've been able to trade a zero-day options since 1973. But back then you could only do it once a month or even once a quarter at the very beginning. So, and then I do want to point out that the last two on the fiction side, that most of the activity in these zero-day options is retail or professional. There's a lot of confusion there, and our data shows it's actually impossible to get perfect data, right? There are institutional, professional customers trading through some retail brokers, and a lot of different kind of users. So there's no perfect answer to retail versus professional. The data we look at shows it is especially the zero-DTE in SPX, where we do have the best data, is mostly a retail product, probably around 50 to 60%. So let's go on to the next slide and just kind of look at how we got here. So this is showing the average daily option volume going all the way back to 2018. The top section is everything combined. So all products with options on them. Currently, there's about 6,000 underlyings with options on them. And then it's showing the activity in the 1 week and shorter expiration term, and everything that expires greater than a week from now. And you see that the growth in the dark blue line is the most extreme and actually overtakes the longer dated flow in 2022. Okay, so you know, and nowadays basically we see about it's actually about 2/3 of the activity is in 1 week and shorter expirations. At the beginning of this chart, it was kind of the other way around. It was 2/3 was longer dated. So this really has been a kind of a paradigm shift in the business. The bottom section breaks that out across ETFs, index options, and single stock, which is really how most of the traders that I talk to kind of they specialize in one thing. They may trade a little bit of everything, but and mostly to point out that, you know, this trend has been most extreme in the ETF and the index space. In the single stock space, there are not currently daily options. There are weekly. So every Friday, there's usually an expiration for about the top 600 names. But this is really an index and ETF thing, and you can see that, you know, it really dominates the activity in there. And we're actually going to look at kind of some of the even more specific, you know, zero DTE, just you know, going from 1 week down to the final expiration day, you know, going forward. So on the next slide, we're looking at there's a couple dominant strategies in the zero DTE SPX. Okay, so, and as I said, it is majority retail on most days at least. And there's kind of two main trades, and I think that, you know, our listeners probably know, you know, people trade outright options, right? They just buy or sell an option, you know, with one kind of goal in mind. And then in other cases, they trade a spread, right? So looking at, you know, simply the outright, the people buying or selling options, there's an interesting trend over the time of day. So you actually see kind of a surge in the morning. So the top section is showing you the opening buying, and that exceeds the selling, and it kind of makes sense because, you know, this SPX specifically is almost a $5,200 index, right? So very high margin product if you were going to sell an option cash secured or naked. So basically customers are a little bit more likely to use it as a buying product. Okay, they can't afford to sell an option, at least not unless they do it in the form of a spread. So what we see is kind of a very consistent, you know, heavier action of buying in the morning, and then towards the end of the day you actually see more closing selling, right? So people are buying options in the morning, selling them later in the afternoon because they're making a bet on, you know, how the market's going to perform for the day. And this is very, very consistent, you know, day over day. So if we look on the next slide, is looking at the complex order activity. So this is actually really interesting in that what we see in that first hour in SPX is a very consistent amount of vertical spread selling. Okay, you've probably heard of people that sell condors. Condors are out of the money call spread and an out of the money put spread. You sell both of them, and basically the trade is you know, you're ideally the market doesn't go towards either extreme, and it just kind of hangs around in the middle, and both of those spreads expire worthless. That's kind of a premium harvesting type of activity. That is actually the dominant flow that we see, you know, dominant use case in the 0 days. And again, that's you know, there's a surge in the morning because people come into that trade, and then they kind of manage it over the course of the day. A lot of traders actually use, whether they do it manually or they use some kind of tools to help. They may do it every 15 or 20 minutes, you know, because it's a capped risk strategy, right? You're short a spread, but you're short, you know, even if you're short spread on each side, you can't. You know, the maximum value of that spread that you're short is the distance between the two strikes. So, and we see this consistently at basically people managing these trades and, you know, using a strategy to exit based on a profit target or exit based on a stop loss. The next slide actually we look at it's just a quick one on value, and it's funny, you mentioned like volatility this year. So this slide goes through April 9th, which was that day that I was actually in Chicago on the SPX on the floor in the morning, but not in the afternoon when it happened. But we ran up almost 9% from bottom to top, and so this is what we're showing here is the P&L on owning a 0-day straddle. If you bought it in the morning and held it right into the close, okay, just a simple way to basically look at how were the options priced in terms of what the final value was. Okay, and that's one of the beautiful things about zero-DTE options is because we have an expiration cycle every single day, we're very quickly collecting a lot of data, right? So even though they've only been around for 3 years, we have almost 750 expirations days that we can look at and see what the behavior's been. So in this case, you can kind of see, there's days that it makes money, there's days that it loses money, and that's kind of what you expect if things are fairly priced. And the options market specifically is a pretty efficient marketplace. That's been one of the big developments over the, really over the life of the product. But things are generally priced right. The summary stats on the left side that I show here gives you the kind of just the average of the P&L if you bought this straddle every morning. I'm not recommending anybody do it, but this is kind of what would happen if you did. The average return is almost nothing, 14 cents. It's kind of wild, right? Because there are days where it was a huge winner, and there's days where it was a solid loser. But overall, you actually see summing up that the first 3 months, the sum was negative $11. Basically, you lost a little bit of money owning the straddle. What's kind of wild is if you just say, let's just talk about this year, right? Because things have changed, right? We have new administration. We've seen, a serious bout of volatility. By some measures, it has gotten as crazy as COVID, okay, in terms of the level of concern out there. And you see in this, if you owned a straddle every day this year, you're actually up huge. Okay, 586 points is your P&L. Okay, almost half of that came on that one day. Okay, that one day that the tariff 90-day hold was announced and the market just exploded. So this is really just I think my main message on this is that generally, zero-day options are priced appropriately for kind of the market conditions. You're going to have days that you would have rather been a buyer. There's days you'd rather be a seller, but kind of overall, it's pretty consistent. But this year is definitely an outlier in terms of pretty extreme volatility and just kind of different behavior than we've seen in a long time. So on the next slide, actually, I'm showing really the two primary kinds of trading that we see in the 0-day. Okay, so I mentioned this at the beginning. There's option buying, okay, tactical trades. I think like yesterday, we were up around 3% pretty early in the day, right? If you looked at that and said, hey, I don't think this is gonna last, you may say, I want to buy a couple of puts in these 0 days. It's a one-day trade. By the end of the day, it's just going to cash out. But what you get by owning a put is the payoff profile in that lower chart on the left, right? So if the market sells off, you're going to start making money, and that is that's the convexity. That's what options are all about. The top chart is basically owning. I'm sorry, I've got them flipped on my screen. The top chart is owning a put. The bottom chart is owning a call. Okay. On the right side is a premium of harvesting trade. Like I said, a very, very popular strategy, and just showing kind of the P&L diagram. If you think about it, like I said, if you're selling an out-of-the-money call spread and an out-of-the-money put spread, okay, the risk on each is capped. And if you think about it, the market can't expire in both places at the same time. So only one of them could be worth anything at the end of the day. But you do have, you're getting some premium, some reward for taking the risk of a big move. The payoff profile of that is what's on the right. It looks like a little bit of a table. You have kind of a profit zone, and if the market shoots through that, you're gonna lose money if you're shorted. In this case, it's that's the table you can see in the background. So, and the reason people like to do this trade is if you think about the decay, right? Options are have a theta to them, they're decaying. If they're currently out of the money and it's going to expire today, then all the value there is decay. Okay, and so the premium harvesting strategy is to try to take advantage of that. And we
I do have a question on that, Henry. It was something I was going to ask you since you brought it up. What is when these options come onto the market, basically, how is the theta? How quickly, I guess, what is do you have like a ballpark number for the theta, like on these zero DTE options?
So it's a great question, and it depends, on how far from the at the money they are. But I actually was just yesterday running through some data, and I like to talk about just kind of the at the money straddle, because even though that might not be the one that people trade, it's the most pure in terms of like, well, listen, if it costs $60 in the morning for the straddle, so you're buying an at the money call and put, and let's say that the market was at 5,000. Well, it has to get above 5,060 or below 59.40 to make any money on that by the end of the day. Okay, and so if you look at the valuations over the whole year, that the price of that in dollars, okay, like I said, market was around 52, 5,500, ranged from about $30 to as high as $120. That's all time decay, right? Because the market is there. Neither one of those is really worth anything unless the market moves. So the time decay can be the entire value, and that the reason I included kind of that chart going down. It's funny. A zero-day option is really just a microcosm of an option, right? So whether you're talking about a 1-month option decaying to zero or a 2-hour option decaying to zero, the shape of the curve looks the exact same.
Right.
And it does take a dive, right? And the option will lose 60 or 70% of its value kind of in those last few hours, if it's a daily, or last few days.
That was my next question. So you usually see more of the decay in the last like hour or two of the day, basically.
Exactly. And you have to, the one thing about one of the reasons zero-day options are so popular is they're fast. Everything's fast. But also the Greeks are not, they're simpler in a way. They're also a little bit less important in a way, because if the market's at 5,000 and you're looking at a put that's $20 out of the money, it's all time decay. And if it's trading for $2, that's $2 of time decay. So it's a little bit easier, and that's why I think people are very comfortable with it. It's like, well, do you think the market's going to close below 50.80 today or not? And you can do that trade. But the majority of that decay really is happening in those last in the final kind of hours of life. I would also just say you have to, even if you do look at Greeks and you really like to think of Greeks, you have to be very careful, because in the zero-day options, things are just moving very quickly, right? So nothing is stable. If you look at a 1-month SPX option and it has 12 cents of decay of theta per day, that's not really going to change. Even if the market goes up or it goes down a little bit, or volatility moves a little bit, it's not going to change very much. But if you're talking about an option that expires in 2 hours and the market goes from here to here, that theta is going to be a moving target.
So another point I like to raise is, as a trader, one of the rules I have, and it kind of ties into one of the graphs that you had that showed, when most of the purchases are taking place. I try to avoid taking or initiating trades like in the first hour and a half of the day. So as we talk about this theta and the time decay, one of the things to consider is that if you're trading that opening hour, the probability of you overpaying on the premium, right, because of the theta is going to be higher, is greater in that situation. So don't necessarily need to rush and place that opening order in that first hour, because you have to factor in that theta value too.
Well, yeah, and it is interesting, right? Like in short dated trading, there are a few. You're right. There's that first 20 minutes, certainly the market's kind of trying to figure out what the day is going to be like, right? So you also have bid offer spreads that are a little bit wider, right at the open, right? People are, it takes a little while for equilibrium to kind of, set in terms of where things will trade. But you also have a lot of economic releases timed for 10 a.m. So a lot of people wait until 10:10, and in fact, you got to be very careful. Right at 10 a.m., the markets in everything in the options world tend to widen out.
Yeah.
And people that trade a lot know this. And if it's 9:59 and you're thinking about doing something, you got to be very careful. You might actually hit go and step into something that's 40 cents wide when it had been
Right.
10 cents wide a few minutes
Right.
before, and it will be 10 cents wide in a few minutes. But basically, as the liquidity community is very, very sophisticated, and and they know historically 10 a.m. we get some big moves. It also happens at 2 p.m. When Fed notes come out, right? So there's a lot of nuances to that kind of zero DTE world, and people do need to pay a lot of attention. I think everybody has their style. Some people actually love that kind of trading the first 15 minutes.
Yeah.
They actually think that there might be a little bit more juice there. But it's important to kind of consider. And then the other thing I think that it's that people really have to pick the kind of trade that matches their style, right? So some people look at a trade and like, I love convexity because, man, if we get a big move, that's what I actually did some work yesterday also on leverage, right? And so the amount of kind of underlying that you're controlling with an option, which in zero to as an option decays, it gets bigger and bigger, right? And there's a cost for that leverage, which is the decay in the option. So there's nothing for free, but with a small amount of money, you can a $3 option on a $5,000 underlying. If it's a 50 delta option and it's in the last hour, the leverage there might be 600, 700 times.
Right.
Okay, which is why you mentioned kind of some of the things we've seen this year. On that day, that April 9th, there were options that went from 7 cents to $260 in SPX, and it's it's simply a factor of kind of that move was absolutely not priced into the market.
Yeah.
And I spent some time digging around trying to figure out if anybody really was kind of ahead of that move. I didn't find anything, but I found plenty of options that went from 7 cents to 200 something dollars, which is really kind of where you look at, you're like, okay, now I understand what convexity is all about. So,
Very good.
let's see, let's go to the next slide. So I'm going to walk through a couple of very specific the trades I've traded plenty of zero DTE options. Actually, I want to go in the right column first because this is the same for the next 3 slides. I've traded options for 30 something years, and they are amazing products. I sometimes tell people they're a little bit like a chainsaw in terms of a tool. Okay, if you don't know what you're doing, you shouldn't use it, and you might cut your leg off. So you have to kind of start out and say, okay, what's my view? Do I think the market's going to crash today? Do I think the market's going to sit in one place today? What's your goal? Are you trying to make, everybody's goal is probably to make some money in trading, but really, like, are you trying to make, are you trying to make a little bit of money in exchange for some risk? Are you trying to put on a lottery ticket style trade, like, which, on that April 9th would have been a huge, could have been a huge winner. So really laying it out, your goal and your risk tolerance, and then making a plan, and the kind of education that that you guys provide, that SIBO provides, and good brokers also do a great job at it. Helps people get into, like, okay, what trade makes sense here? If my view today is that we might see a move to the downside, which is what this this chart on the left shows, then owning a put, buying a put is what's going to pay off. Okay, so but there's a price to that, and that's going to be my risk. The risk is it's going to go out worthless. So and then actually having the plan for how are you going to carry this trade through. Like, what is your target? What's your profit target? If you go in without knowing, well, what am I going to do if the market crashes? Like, what am I trying to make here? 10x, 50x? What am I going to do if the market goes up? Is this a trade that I'm just going to turn on? I'm going to put it on and not look the rest of the day, or am I going to cut my losses if it loses 50% or something like that? So, having a consistent approach is huge. My first boss in the industry was Blair Hull, who's a famous trader, and he used to say, like, even if your model is not exactly right, or what you're doing might not have any true edge built into it, as long as you're consistent, you'll actually do okay. So it's the changing your mind, and one day I want to make 10x, and the next day I take my profits at 2x. is really where some traders get into trouble. And then sizing, I think, is really probably the other important thing is people have to be very realistic about how much of their portfolio they put into a trade. And there's some rules of thumb, a couple percent, 3-4%, at most, is what I've seen good traders do, and not really vary from that. So that applies no matter what you're doing. So just kind of walking through what we're looking at on the left, basically we're looking at the P&L diagram of a put purchase, right? This was on I think I might have used SPY on this one. 598 is the underlying, and what you see is green on the left if the market sells off. You can do this in the form of an outright put. You can just buy a put. You can do it in the form of a put spread that will kind of give you a capped return if we go down. And the places that that we see people doing this is you're trying to adjust exposure. Like yesterday's a really good example. Market's up 3%. Maybe you have some core longs. Most people do, right, in their 401k or whatever. And they're like, you know what, I'm a little nervous. This is not going to last. It's going to fade out. And so I want to buy some puts to limit my exposure. You can do that, or you can sell the stocks that you have. But a lot of people don't like to do that because that usually will trigger some sort of tax implication, and also maybe the market just keeps going up, and if you've kind of gotten out of your longs, that's actually going to hurt. So a tactical put hedge is one of the most basic things, and it's also used for catalysts, right? If you're waiting for the Fed announcement and you're worried about a real dislocation because of that, this is the kind of trade you would do. So but we'll look at some of the risks. Go ahead to the next slide. This is until August 9th, this was kind of one of the most extreme moves that we'd seen. So this was in March, and we sold off, this is an SPX, from 5,800 to, we sold off over 100 points in the S&P futures in about 15 minutes. Okay, so it's about a 2.5% move. And I like to show this because and actually since then, we've continued to see moves that are kind of theoretically impossible, right? They're theoretically impossible because the theory is flawed. People talk about normal returns and Brownian motion. Markets really don't move that way, but it's the best tool we have. But in this case, you can take, in terms of volatility, a lot of people think of VIX, right? VIX is a measure of volatility coming from the SPX options at a 30-day term. So, today VIX is back down to, 35-ish. It spends most of its time kind of in the 15 to 20 zone. And then when people panic and options get really, really expensive because the reality is the market, could be anywhere, volatility can explode and go up to, we've had it actually go to 83 times. So if you take that VIX and you actually can back out what the expected daily move is, right? That's the rule of 16 people talk about. So a VIX at 16 is actually kind of implying a move of about 1% a day. You can take it even further using minutes, and that's what I use to kind of get this math. The chances of SPX moving 2% in 15 minutes basically were 1 in 29,000. Okay, it's not supposed to happen, but it happened. It happened that day, and so it's important, kind of when you're thinking about risk. Weird things happen, things that don't make any sense happen, and I see a lot of people get in a lot of trouble because they're like, it doesn't make any sense. It doesn't make any sense that the market's up 9%. It doesn't really have to make any sense. So, like, we talk about the known, the known risks, some tweet coming out, or, some disaster. These things are, these things happen every once in a while. But there's also in the unknown risks, weird things, right? Cancels don't cancel. Stops don't trigger. You lose your internet at your house in the middle of a trade. Like, people have to really actually keep these things in mind. And you just can't always assume everything's going to go perfectly. And COVID was kind of a great example of, like, markets doing really bizarre things, right? It was impossible that GameStop could go to, from 30 to 300, but it happened.
Yeah, one of those environments to survive versus being a hero, right?
Exactly. So exactly. Don't be a hero. Don't impose your, like, this doesn't make any sense on the market, because it'll just sting you. And then one thing I will mention is those last two at the bottom, the early exercise and assignment and post-market moves, those don't apply to SPX or XSP, which is the mini SPX, because those are cash settled index products. If whatever you own, if it expires in the money, you just get the cash difference. It's one of the simplest options out there. There are also European style options, which means that you can't exercise them early, and if you short them, nobody can exercise them on you early. When you look at zero-day options in ETFs and single stocks, right, those are physically settled. So if you have calls and they're in the money, you're actually gonna buy the stock or the ETF. And there are some funky things that happen in those in the short dated, because what happens is, even though the option stops trading at 4 o'clock on the day, you can control the exercise until about 5:30. And if the stock closed at 100 and you were long some $95 calls, they're going to get assigned automatically. They're going to, the auto X by OCC is going to say, okay, here you go. You now own stock with a $95, stock price. But what happens if the stock sells down to 85 after the close? You don't want to exercise those. You need to call your broker or use the tool to say, it's called a contrary exercise. I don't want them. But it also gets really gnarly if you have a spread on, because you don't necessarily know which is the other side if they know that the stock's trading at 85. So it's something that's very important to understand. It's one of the reasons people kind of tend to prefer index options for these zero-day DTE. It also means that, if you think about it, if you're long physically settled calls and they're now in the money, you have to have enough capital to buy the stock. And with an index option, you just have to have enough to have bought the option. It doesn't matter, whether if you bought something for 7 cents and it's worth 266, God bless you, first of all, but it settles into cash. So risk is important. Let's look at the next slide, which is one of the premium harvesting strategy examples. So on the right, same thing. I don't go into any trade, and nobody really should go into any trade without the plan. What are you trying to do? Because otherwise it's a random coin flip, and it's not worth doing. On a premium strategy, you're selling, as I said, you're selling to, a vertical spread or two to collect premium. It has limited risk in that that it could expire worth the maximum value, but it can't expire any worse than that. So it also controls the margin. You only have to put up the amount that is the maximum loss on one side if you're talking about a put spread and a call spread in the same underlying. So for example, in SPX, if you sold a 10-point spread, put spread, and a 10-point call spread, you only have to have the 10 points in your account. Okay, so $1,000 on a one lot, and you're collecting premium on both. And so the payoff looks exactly like this. So if all those options expire worthless, in this example, it makes $520. You have risk of of one of those spreads maxing out. So that needs to be understood. Some people try to trade out of it if it approaches the strikes. Kind of personal preference. I would really rather just put on a spread that I don't have to close. I'm going to take the maximum loss, but I keep the trade small and do that. And with the 0 day, it lends itself to people doing it repetitively every day or even multiple times a day. And then some people say, well, but Thursday is Fed day, so I'm going to take Thursday off. Okay. In some ways, I've seen people do okay, including those days or excluding them, because the premium is going to be higher on a Fed day. But it's also the days we get some of the biggest moves. So, and then we can look at the next one, which is actually a real trade that I was able to snap out of our system. So this is in SPX, a 10-point iron condor. Okay, so you can see in the top, it's all put together, but I will take it apart. With SPX at 61.22, okay, somebody, this is a real trade, as the person did this, somebody sold the 60-50 and 60-50, 60-60 put spread, and they sold the 61-50, 61-60 call spread. Okay, they collected $1.85 in that trade. Okay, and this was at the very end of the day. So this actually might have been a next day trade, because we see a lot of 0-day trading, and then we also see a lot of trading for the tomorrow, especially towards the end of the day. So this was yeah, I didn't put the date on here, but and so you can actually see the pieces of this whole thing. So you can see the price on each leg. It doesn't actually matter what the price was on each leg, because really all the trader cares about is the net price. But they're all there, so that overall they collected a credit of $925. Okay, they got 60 cents on the put spread and $1.25 on the call spread. So in this case, they didn't pick kind of equidistant strikes. Okay, in fact, this would be kind of like a similar trade to what somebody could have done yesterday if they thought the market might pull back. Right, stock was at 60, or the index was at 61.22. So the fact that they picked the call spread that was only 20 bucks away is why they got more money for it. They got $1.25 for that call spread. They only got 60 cents for the put spread, which means this trade kind of seemed to express a little bit of a view that we wouldn't go any higher. Okay, they're collecting $925, and the risk is that it blows through one of those spreads and the thing expires worth the maximum value, which would be 10 bucks for one spread, $4,075 in risk. So and they have basically anywhere in between 60-60 and 61-50, they were in great shape, because everything was going to expire worthless. And in reality, because they're index options, even if we expire a buck or two, basically you could expire $1.85 into one of those spreads. So 61.50, 185 would have really been the break even if we'd gone up. If we were up higher than that, then they would have lost money on it. So and this is this is kind of one of the most popular trades that we see. We see it we estimate about 400,000 contracts a day, kind of in the form of these condor spreads, out of about 1.5 million zero-DTE SPX trading each day. So and that's it for kind of slides, but I'm happy to kind of talk about other things I've seen. So.
Yeah, what I would like to do real quick, Henry, is just talk about some of the technical tools that I use to kind of help measure where we might be on a on a daily time frame, on a very short-term time frame, because you gave that last example on the iron condor, the trader making a bet basically that you wouldn't rise anymore, right? So there's a few different calculations that you can use on a daily level. You're probably familiar, I'm sure you are, Henry, with stuff like expected move. Those have different time frames. You have weekly ones, daily ones. But in looking at the intraday stuff, if you're doing these 0-DTEs, you probably want to be looking at the chart on a shorter time frame. And so here I am looking at the hourly of the S&P 500. You can see here that you are on an hourly resistance zone. We've seen prices trade in this like 54, 60, 54, 70 ballpark a couple of times, actually a few times, going back to the beginning of the month. So this is a pretty important level, and it's interesting to see the round trip that we've taken, over the last month here in the market. But I also have these Bollinger Bands on this chart here. Usually when you're trading above or below the Bollinger Band, it suggests that the market is extended in one direction or the other, a couple of standard deviations away from the mean. You can always adjust that too. So just wanted to share some practical tools that traders can kind of incorporate when building these strategies on whether they want to be bullish or bearish, directional bias in one direction or the other on these options. So again, you said, like, coming into a trade with the plan articulated ahead of time. And, when you're getting into this and you're new, it's going to take more time to build your plan, right? But once you have the framework built out, you can do the analysis on the fly a little bit more quickly. But the last thing you want to be doing with these types of products is putting on those coin flip trades. Okay.
Yeah.
So go ahead.
No, I was going to say, it's funny. In my early years, I was trained like technicals were bad.
Yeah.
And but I did come to later kind of think of it more as, there is supply and demand, and there's people making decisions, and and that, having a view. It's funny, when I started in the business, you could make a lot of money in options trading, especially as a market maker, which is why I started out, just by basically taking the order flow that came to you. Okay, there's a very big bid offer spread. Effectively, we were able to keep it. That's changed, right? The markets are incredibly efficient now, so the bid offer spread can be, is a nickel, maybe in a lot of cases it's a penny or two. So the friction in getting in and out of trades is really, really low. You have to kind of have a view in a trade. You really do, and I absolutely think that technicals can be really helpful. Again, I think consistency is learning something, really paying as much attention to it as you possibly can is crucial. But we think about it, volatility traders, right? Like I said, VIX goes up and goes down, right? When VIX goes up to 70, it tells you that there's a ton of fear, there's a ton of panic. But we also know VIX never stays at 70.
Right.
Okay?
Right.
Now it may stay there for weeks, okay, or it may stay there for for 3 days. That it's not as easy to just say, okay, how can I kind of be on the sell side of that? But volatility in whatever you're looking at kind of has a range, right? We use percentiles in kind of the way we think about things, and like if vol is in the the low fifth percentile, I don't know if it's going to pop up or not, but I don't want to be a seller of it. It's like, so in a way you could say, listen, okay, what kind of trade? My view is that the right side of the trade is to be long some premium, okay? Because I think it's just historically at the low end of things. And then you go and you look for the trade that, from that starting point. And I think technicals are kind of the same thing. It's like, okay, I'm looking at this and it's telling me that, I want to lean this way. And then options are a spectacular product for that, because you can be like, listen, I think, whatever, we're up 1% today. Yeah, I think we might get up another 10 or 15 basis points, and that's it. I'm comfortable not, I'll take that bet. And if you'll give me, $1 for a product that, worst case is going to cost me, 5 or 10, then, you can do it. You can do it you can do it today.
How were the bid offer spreads on these zero DTEs during the recent bout of volatility that we had?
At the moment when we really moved, things did blow out. We see that in kind of any real crisis dislocation, right? They came back, pretty quickly. So, in general, the zero DTEs tend to be a nickel or a dime wide for kind of, everything from at the money to out. I think we did see some wide markets for about 20 minutes. Meaning like got towards a few dollars briefly.
Wow.
And which is considering like the difficulty of trading, you have to realize that the other side of every option trade is generally a dealer, a liquidity provider. Okay, they're not necessarily going out and hedging your trade with an underlying instrument or a future or something like that, but they really do have to kind of they are running a hedged book. So the fact that markets didn't disappear when we had a move like that, where you do have some instruments, with insane returns, kind of shows you how robust the whole community is. It also means that traders need to know what they're looking at, right? Like throwing a market order into a vacuum is a disaster. It's guaranteed to be a disaster. So, so people need to use limits. They need to, ideally use, have some tools that help them know where things are worth. In a bunch of the CVO platforms, Trade Alert and LiveVol, we have theoretical values on everything. Meaning, like you can look at, the SPX, 20 point out of the money put. It might be quoted 2 to 210, and it might be worth 203, and you can see that it's worth 203, and that's our modeled value, but it's a very solid model. And it's also meaning if something weird is going on, or if you're trying to price a spread, you only have to kind of, especially on a spread, you only have to do the calculation between two values rather than first figure out the midpoint or the offer to bid and that kind of stuff.
We did have a question from the audience. Can we get that up on screen, please? Let's see. All right. John Stoner asks, any thoughts as to one, why the first hour is so volatile, and two, the type of trader, retail funds, etc., in the first and last hour?
I mean, the first hour, you mentioned kind of avoiding at least the first half hour. So, options are primarily valued on the part that nobody knows is the volatility,
Mm-hmm.
right? All the other inputs to the option model are easy, where the stock is or the index, all the other parameters are fine. Implied volatility, what is the right volatility for the next month or the next day, is a matter of equilibrium, and so you need kind of a market to develop for that. And so in terms of so option traders, and I did this for a long time. If you turn on your machines and you're basically pricing everything, if you're going to assume that the morning is just like yesterday's close, okay, a lot of times that's a great assumption, but sometimes it's not. Sometimes something weird happened overnight, and then you're like, I don't know, I don't want to be the first one out there. So I think in a lot of ways, the liquidity is reduced, and so in terms of volatile market moves, the first hour and the last hour, are more volatile because there are a lot of strategies that kind of are coming in and going out of the market at that time as well. So like you have less liquidity and you have more flow. I mean, especially towards the end of the day. I mean, for the underlying stocks themselves, I think in the States, close to 10-12% of the volume is printing kind of in the market on close. So you have a lot happening at the end of the day. So, and then the types of traders, the institutional kind of audiences, they're kind of always out there. Retail traders, we see, like I said, we see very active at the beginning of the day, and then towards the end of the day, they're basically managing their trades. They're trying to unwind things, right? That's why the volume spikes and then it kind of slides a little bit lower. And then funds and ETFs that are now a big user of options as well. They're towards the end of the day, because usually whatever rules they're operating by, are kind of specified on kind of where the close is going to be. So, if they're hedging for a certain period, they kind of want to tie that hedge to where the market closed.
I actually have a follow-up question to that, Henry, and has to do with risk management. Given the high leverage and these rapid price swings that we see in these zero-DTE options, what are some of the good risk management techniques, beyond necessarily stop losses or position sizing, can a trader employ to protect their position while still capitalizing on some profit potential?
I think that is probably the biggest challenge, because there are days where a risk management saying, I've put on this trade, and it's not so much about your profit target at that point, right? It's about my maximum risk, right? Like, I was willing to lose $1,000, and something major's happening, and I'm quickly approaching that. There's days where you can then basically follow the rule, the goal that you set, and just exit the trade. There's also days where markets get really, really choppy, and so it's one of the reasons stop orders are sometimes backfire in options, right? Is you got to remember that, like, stop orders on stocks and futures, it's a little easier. There's one instrument, it's moving around.
Yeah, right. These are derivatives, right? So it's different.
it's different, and there's also a whole bunch of options. I mean, there's actually 1.7 million options being quoted at peak time in the cycle now. So it's a good question. I would say most of the time you can trade in and out, very, very without a lot of friction. And then, but you have to. I guess the biggest risk management kind of concept is, like, you got to be aware that sometimes your slippage is going to be $1 or $2. Other times it's going to be a nickel. Yeah. Most of the time it's going to be a nickel, but every once in a while you're going to get in this situation. That's part of kind of how markets work. Like we do not have, markets are just a whole bunch of participants kind of meeting together. And if something major is happening, a lot of those participants disappear, or they step back and say, I don't really know what's happening here. And you don't ever want to be in a position where you have to trade out of something. I think that's when you're thinking about the trade, you can say, listen, my target is this, and this is what I expect to do. But you absolutely have to have kind of a worst case. What will I do if, you get weird things like unscheduled closings and market halts, and
Yeah.
bad things happen. If you trade long enough, you're going to see all of them. And, really since, I've been doing this forever, but, even just since, COVID era, that's only going back 6 or 7 years. We've seen everything. We've seen, extremes in volatility. We've seen dislocations. We've seen markets basically evaporate for a period, and then it takes them a while to come back. And you need to be able to kind of wait it out.
Great. Well, Henry, thank you so much for that. I don't have any other questions unless you have anything else from the audience. So any final words as we wrap it up here?
I think just to if somebody's thinking about trading options, start small. Start with maybe a small product like XSP, which is it's a $500 underlying. Trade one at a time. Just start as small as you can, and study what's going on. Why did this trade work or not work? And don't think very much, but the options make so many things possible, especially once you get more comfortable with things. So no, I'm just happy to see all the interest. It's great. It's why we're seeing record volume levels, record days.
Well, you mentioned something really good. If you're not going to win small, you're not going to win big. So with these highly leveraged products, start small, get your feet wet, and figure out a system and a method that works for you, that aligns with your own personality. That's the best takeaway that I could send.
Be realistic. I had, when the sell-offs that we had in the last 2 weeks, they've been rough, right? I'm getting texts from, friends that I barely talked to saying, I can't believe how much I've lost. And I'm like, well, wait a second. Market was up, market's up 150% in the last couple of years. Right. Like you've been in it, right? Like, well, yeah, but
stocks only don't go up.
Well, that's exactly. It's like, they don't only go up. They're gonna move around, and if you're gonna get shaken out by by a sell-off, then you're probably not doing things the right way.
Okay, last thing I want to ask you, then we can end this, is where can viewers find more educational resources from SIBO?
So we have at SIBO, we have the Options Institute, which is a great place for like the nice foundational stuff. What's a call? What's a put? What's a vertical spread? So I would go to SIBO.com. Once you get there, I think the Options Institute is linked there. We also put out Market Intelligence with the team that I'm on. Also, same thing. Go to SIBO.com, look for Market Intelligence. And like I said, the brokerage community out there, modern platforms do things. They're elegant, they're accurate. They do things that I spent decades kind of trying to do the hard way. So use a good broker, understand the tools, and and keep it small, like you said.
All right, Henry, thank you again so much for joining us, and thanks to the SIBO for getting all this material ready. That'll do it for today, everyone. Thank you so much for joining us, and we will definitely be continuing with these educational sessions to help familiarize you with the amazing suite of options products that SIBO has been building out. So, Henry, thanks again.
Awesome. Thanks, Johnny. Thanks, everybody.
All right.